Hello and good afternoon, everyone, from Minneapolis, Minnesota. On the final bar today, we're going to recap the market activity. Clearly some upside follow through with communication services, healthcare, financials, all leading the S&P higher. We're going to have a guest, Jeff Hughes from JWH Investment Partners here in Minneapolis. We're also going to open up the final bar mailbag, talk about how to think about relative performance, also the CMT designation. Ladies and gentlemen, this is the final bar. Hello, good afternoon, everyone. Welcome to the final bar. This is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com. Instead of coming at you live from Redmond, Washington today and this week, the final bar is actually on the road. We're here in Minneapolis, Minnesota, where I'll be speaking with the CMT Association Minneapolis chapter here very shortly. But had a chance earlier today to catch up with Jeff Hughes from JWH Investment Partners. We're going to share a little bit of his interview a little later in the show. Also caught up with Craig Johnson from Piper Jaffray. And tomorrow we'll be out with Ralph Acampora outside of Minneapolis at his farm, where he has a fantastic repository of Wall Street history and the world's largest chart of the Dow. So some really cool things coming to you, and we'll enjoy bringing some of this content out for you in the next couple of weeks for sure. Wanted to just recap the markets. You know, we talked yesterday about earnings and how important all the financial companies reporting, JP Morgan, Citigroup, Goldman Sachs, others, and we'll see how that actually played out. But I think the chart speaks for itself. So here's the S&P 500 and the upside follow through. Traded above 3,000 on the S&P, settled back down to 29.95, but certainly an upside follow through day, and that's on the back of pretty solid earnings day all around. It's funny, again, the goal of this show isn't to unpack earnings too much, but really to focus on the charts. But a lot of the discussion I've been hearing is how, earnings is giving you questionable upside, right? The earnings environment is not overly positive, but boy, a day like today certainly feels like there's upside momentum here. So, at this point, what do we think about where we're at? Well, again, we're rallying very nicely. We're getting higher highs, higher lows. That's all good. We're now entering this really key resistance area. And for me and many other strategists, the question isn't, are we in an uptrend or downtrend? It's all about the potential to go to much further highs, right? What's sort of the staying power of this uptrend? And for a lot of us, it just seems to be limited upside in terms of, the resistance area that we're approaching here from sort of 30.10 to 30.30. That's going up to the previous highs from July. And so, if and when the S&P is able to recover and move to new highs, would certainly be a change and an unexpected change for a lot of strategists. Just for sure. Just thinking of some of the weaknesses we've talked about in breadth, small cap versus large cap, all these other sort of macro headwinds from a technical perspective. Interestingly enough, Jeff Hughes, who we're going to hear from in a little bit, talked about transports in a way that I think might help to give a little bit of clarity to the macro picture as well. Here's how today actually looked. This is on the right side. This is just looking at the last 5 days of trading. So here's today, here's yesterday, lighter volume day with the holiday, and then Friday and into the previous week. A lot of days recently, the last 30 minutes have been more distribution than accumulation, and that certainly played out again today. We'd rallied very quickly out of the open after earnings pre-open, sort of stabilized for much of the trading day, and then look again how the last 30 minutes shows a lot of distribution. So again, that tends to imply institutions taking profits, sort of taking some off the table, selling versus buying. But again, the trend speaks for itself. The trend certainly has been appearing to go higher. Sorry for whipping around the charts here, but I wanted to get to the relative rotation graph. We've looked at this a number of times recently, and I wanted to highlight this only because the picture appears to be fluctuating very quickly. So here we have the traditional defense, like utilities, like real estate, like consumer staples. These have been furthest to the right, being the strongest sectors out of the 11 S&P sectors. If you look what's happened in the last couple weeks, though, starting to see a bit of a downside rotation. And again, this is on the weekly view, so it's looking a little more longer term looking at the relative performance of these sectors versus the S&P in the middle. But you can see how these are rotating down. And again, when they're rotating down and to the left, sort of suggests sort of an unwinding of that side of the trade. And then look how technology, consumer discretionary, both rotating back to more of a positive inflection point. And what's interesting above all of these other things that I'm pointing out here is technology is down here. And looking at the RRG for a number of years, one of the most interesting patterns I've seen is when something is in the leading quadrant, comes down into the weakening quadrant, and then kind of hooks around and rotates back. And if it gets back going up and to the right, a lot of times that's sort of the buy on the dips sort of mentality. So it remains to be seen whether that's the pattern we see, but I think it's worth noting and keeping an eye on. As I mentioned, a lot of financial stocks reporting, a lot of banks reporting this week. The XLF rallied very, very nicely, still closed higher, came off a little bit toward the end of the day. But again, the concern with something like the XLF is this really key resistance level up here. This is around 28.25 to 28.50. And again, you would want to see the XLF close above there. We're going to look at JP Morgan in a moment. But again, a lot of these stocks, looking good, excuse me, in the short term because of earnings. But, again, with a lot of upside resistance there. Here's a chart of JP Morgan. Just updating the chart very briefly. We can see that we close, excuse me, right around 120. Now, the benefit here for something like JP Morgan is it's getting above the September high. So looking for stocks breaking through previous highs, breaking through on increasing volume, new relative highs, all of that very, very constructive. The question now for me after an earnings beat, after a nice performance, is to see what sort of follow through we get tomorrow and beyond. And that's what we're going to have to see with something like JP Morgan, and I think broadly speaking with the XLF, some of the other banks that we've been looking at. I want to finish off looking at the scooter rankings. And there's been a lot of movement in here. I can't highlight all of these things. And again, on your members dashboard, if you've not done this in a while, I'd encourage you to set this up with some of the scooter reports. It's a great way to just see which stocks are moving to the upside and the downside, and which ones are seeing significant fluctuations in their trend. On the up moving scooter rankings, we have something like United Healthcare. You'll see a lot of healthcare names in here. HUM, ABT, Abbott Labs, all of those showing a nice upside follow through today, a gap higher for a lot of them, and a number of them have broken above their September swing high. So that's kind of a compelling, upside idea there. Also, NVIDIA. So semiconductors, we've talked about the relative performance of semiconductors for a while. NVIDIA now has eclipsed its April high after having this nice sort of accumulation phase, breaking above previous highs after bouncing off of the 50-day. So NVIDIA, kind of a compelling chart here. And then the final one I just wanted to highlight was P&G, Procter & Gamble, in the consumer stable space. We've talked about this before, and again, it's testing the 50-day moving average. We talked about this yesterday, the day before, now actually breaking down through the 50-day moving average. So if something like that is not able to hold the 50-day, certainly suggests a rotation away from consumer staples into other places. That's a quick market recap today. I just wanted to now bring on my guest, Jeff Huge. So Jeff, I've known for a number of years. He's the Chief Investment Officer at JWH Investment Partners outside of Minneapolis. He's been a longtime financial strategist and also equity salesperson, had a great career at a number of prominent sell-side shops, spent much of his career here in Minneapolis, now runs a family office as a Chief Investment Officer. We had a lot of fun today, sort of unpacking his process, thinking about a number of things, but he highlighted three charts that are top of mind for him. So let's hear this interview with Jeff Huge from JWH Investment Partners. All right, Jeff, thanks again for joining us. You sent three charts, which I really found interesting. The first one was looking at net new highs over time. What is this telling you?
Yeah, well, if you take a look at the S&P 500, as its advance has progressed, we've seen cumulative net new highs progress right along with it, and in many cases leading it all the way to its pinnacle. And in fact, when we saw the pullback in February of 2018, net new highs, cumulative net new highs, didn't really take a plunge. I mean, they pulled back somewhat as the market did, but as soon as the market started to advance again, cumulative net new highs broke out and began to lead the market to its new high. Right. And as the market peaked again in September of 2018, net new highs began to roll over. And they began to plunge as the market began to plunge and really hit their nadir in December as the market did. The thing that caught my attention is as we've seen this bungee cord explosion off the lows in December of last year, net new highs did not commit. We just didn't see new highs recover to the same extent that the market did. And as we've made these three separate peaks in 2019, I believe in April, July, and now September, I think new highs, even though they've made higher peaks, have not broken out and made higher highs. And so that's concerning. I mean, the fact that new highs are not keeping up with the market is something that I think investors need to pay attention to, because it really calls into question whether or not the bull market has the strength to continue to progress.
Very good. This second chart I love because it's such a long-term orientation. I'm always talking to the viewers about, make sure you're plugged into the long-term trend. What is this showing you, this chart of the transportation index?
Yeah, so we titled the chart Economic Cycle Model, and I've done a lot of work on trying to identify different indexes that are strongly correlated with economic cycle. And in that, the transportation's ranked number one. What we're really looking at here is a series of shorter term cycles around 7 years on average, and then a longer structural cycle that's about double that time frame. And as you see, each time the transportation's peaked, they peaked around the top of the economic cycle, but the momentum, which is the lower panel in this chart, shows a 36-month momentum. And that momentum study tended to diverge pretty aggressively as the index itself made new monthly closing highs. 36-month momentum did not confirm it. And so that was an excellent tell at the cyclical level. And it preceded declines in the transportation index, which tended to culminate with recessionary or economic declines, and tended to hit their nadir on or about the point in which the recession hit its lowest point as well. And this occurred in 2002 as well as 2009.
Right.
And what we saw as we went into the kind of 2015 malaise, or 15-16 malaise in equities, transports rolled over, and we did see a mid-cycle slowdown in the economy, but it wasn't a full-blown recession. And even though many indexes saw 20% declines or more, transportation's got right back up and rallied to new highs as recently as 2018. And what we noticed is, if you look at the 36-month momentum in the bottom panel again, there are two divergences, one marked in red and one marked in blue. The blue is the traditional kind of top of regular cycle or short cycle, but the red is this much larger negative divergence that spans over around a 3+ year period as trannies rallied to their 2018 high. And so our view at this point, our question really is, have we hit kind of this secular mega top as opposed to just a traditional cyclical top? And if so, what are the consequences for the market? And I think if we see follow through to the downside in the transportations, we'll probably be able to conclude that this is a much more significant economic downturn.
Oof. A dire chart then. And then very quickly, the last chart was on the EWJ, the Japan ETF. What are you seeing here?
Well, this is an interesting chart because we're going back all the way to 1996, I believe.
Right,
and this is a monthly close. We've got a fairly substantial breakout out of a what I would call a Brobdingnagian base, for lack of a better term. It's just a huge base.
Yeah.
And we could call it an inverted head and shoulders base. Some might draw the lines a little differently, maybe say it's a triangle of sorts. But any way you look at it, I think that base is certainly resolved to the upside and has put in what appears to be a 10-year uptrend. And I think this latest consolidation appears to be breaking out, and we've seen it confirmed by momentum. This is 12-month annual momentum in the top panel. For me, when I look at the various countries across the international spectrum, this is the only country that I've really had an opportunity to upgrade recently. We recently upgraded it from bearish to neutral, and I would be probably looking to upgrade it to bullish and very quickly if we see some follow through here.
This is perfect. 3 really good charts, Jeff. Thanks so much.
My pleasure.
So that was part of my conversation with Jeff Hughes from JWH Investment Partners here in Minneapolis. We didn't get too much into that in that part of the interview, but Jeff's had an incredible career and has essentially learned technical analysis from some of the greats in technical analysis, guys like Alan Shaw, Luis Yamada, Dick McCabe, many others from some of the prominent sell-side technical research shops in years past. So really, really interesting. We captured a lot of really good thoughts from Jeff in terms of his process, other things that we'll look forward to sharing with you in the next couple weeks or so. So really appreciate Jeff sitting down with us earlier today. We're going to take a quick commercial break, and we'll be back with the Final Bar Mailbag. See you in a minute. Hello, everyone, and welcome back to the Final Bar. This is your host, Dave Keller. As you know, you can get questions to us at any point via email, thefinalbar@stockcharts.com. You can also get to us on Twitter @FinalBarSCTV. Really appreciate all of you that have sent in questions. We haven't mentioned it too much, but we have a chat room open during the show, which we are monitoring. Sometimes we're able to get to those questions. If not, we save them and try to get to them during a mailbag session. So any of those ways, if you have questions on the markets, on using stock charts, excuse me, or on a particular screen or chart that I'm showing, put it in there and we'll do our best to address your questions. Just want to highlight some of the great questions that have come in recently and talk through them. Number one, I'm going to call myself out for poor chart awareness. Someone asked about my use of the new highs and new lows and wanted to point out, looked like I was drawing conclusions based on a new high, new low number that hadn't actually registered yet. And you were absolutely correct. What I did was I was looking at the price, excuse me, looking at the bars on the bottom and not realizing, because a lot of those are going to wait until the end of the day, depending on the indicator, depending on the chart, most of these will populate at the end of the day based on the price action, based on getting final closes from a lot of different price data sources. And so you will finally see the new high and new low number update a little later. It's usually around 4:30, 5 o'clock Eastern time, depending on how a lot of that data sort of resolves. So at this point, I don't have the completed number for today. So you want to wait until you get the confirmed number. The easiest way to know if it's updated is look at the price bar and then look down and just see if there's an updated bar for today yet. In this case, it is not. So you want to wait until you get the confirmed new highs, new lows indicator to make a proper assessment about today's short-term action. So nice catch from one of you, and thanks so much for pointing that out. You're absolutely right. Someone had asked about looking at relative performance, and in a lot of my conversations today with guys that deal with institutions, people like Craig Johnson from Piper Jaffray, people like Jeff Hughes, who you just heard from earlier in the show, they deal almost primarily in relative strength, because relative strength is essentially the way that an institution measures their performance, right? You own stocks that are outperforming, you're doing well. If you underweight stocks that are underperforming the market, you're doing well. And overall, that's the game, is to be on the right side of that relative trend. So the question was, how do you actually create the relative trend line that I'm showing here, the relative performance? So here's what you do. At the bottom, there's a field that says price performance. That's the indicator you want to pick. And then you just put in a ticker and then the colon and then whatever you want the benchmark to be on the right side. And what it'll do is when you run this chart on other tickers, it'll update that left side of the chart for the thing you're looking for. Now, a couple quick comments. My counterpart, Gaddis Rose, who's a very capable trader, investor, and educator. If you're not familiar with his work, certainly encourage you to do so on his blog on StockCharts.com. He has his pre-canned chart style that is based in a lot of ways on relative strength. So here he's looking at the stock relative to a total market ETF, essentially like a broader S&P universe. Then this is the sector that it's in versus the broader universe. The industry group versus the sector, so how banks in particular are doing relative to the broader financial sector. And then this company, the stock versus its industry. So between those four, you get a good read for how is this stock doing relative to all the other stocks out there? How is this sector doing versus all the other sectors out there? How is this stocks group, banks, doing relative to the sector? And then how is that company doing relative to its individual industry group? And each one of those gives you sort of the overall understanding. If you look at the bottom of his preset chart style, you'll see exactly how he set it up. So you can use the nomenclature $ symbol, $ sector, $ industry to create all of those different combinations. So if you didn't follow what I just showed you, no problem. Here under chart styles, below all of your charts, you will have a pre-canned one called Gaddis Rose. It'll be down here toward the very bottom. If you bring it up, you can save it to your own login, make changes to it, but those top 4 lines will show you everything you need to do to incorporate those relative performance charts into your own work. Now, I did want to point out, someone had asked about what benchmark you use on the right side of that. And if you notice on some of mine, I actually have the ticker and then the S&P 500 $SPX. A very aware viewer pointed out to me, and you're absolutely correct, shouldn't I be using the spiders? Because on our system, the S&P 500 does not include the dividends. It's a price only sort of measure. So it's not a total return index. And so you're going to understate the relative performance if you're not incorporating the dividend component, depending on how you're measuring it. So what I've done for most of my charts, and I'll catch the others as I go, I have it relative to the SPY, which does incorporate the dividends, and it'll give you an apples to apples basis. If you do the ticker and then do the SPY, you'll get a total return comparison when you're looking at price performance over time. So great questions and great catches for a number of you. Last thing I wanted to hit on, someone had asked about the CMT designation. As you know, seeing my name in a number of places, you know, there's the CMT there. And I've just interviewed 2 fellow CMT charter holders, Jeff and Craig, here today in Minneapolis. And so is it something that will help you as an individual to invest? And my comment to you is, of course, I mean, the goal of something like the CMT program is to help you understand the dynamics of the market and understand it through a technical lens. It is a very systematic way over a course of 3 exams over at the very least a year and a half of your life. You'll have a very systematic, disciplined process of learning all the pieces of the technical toolkit. So from that perspective, I think it's really, really important, especially because if you're learning on your own, you're just picking things up where you can. It's hard to have that structure, and that's what something like the CMT is able to provide. But I would caution you, because the person that wrote in is an individual investor managing their own account. And the question was, is it going to help me, trade for a living, develop my own trading system, trading platform, trading approach, and use that as my main source of income? And I would say a little different, because the CMT, if you're not familiar, is a professional exam. So something like the CMT is actually designed for market professionals, for industry professionals managing money or working with money managers using technical analysis as a primary input. And so there's actually a work requirement that you need to fulfill. You have a professional requirement that needs to be signed off on by some sponsors to actually give you the exams, to give you the formal designation. So my point of all of that is to say, yes, something like the CMT that gives you a structured approach to learning technical analysis, I'm a huge fan of. And I know for me, I had read some books on charting, but going through the exams really formalized what I knew and what I needed to, what I wasn't aware of that I should have been. Does it help you create your own process of trading for a living? That I would say it's not designed for. It's really designed more for professionals. So I would point you to some of my fellow StockCharts contributors. People like Gaddis Rose come to mind. Tom Boley comes to mind. Alexander Elder, who's been a contributor to Stock Charts for a number of years. These are people that have built their approach on helping individuals, be empowered to trade and use technical analysis for their own investment. So I'd certainly encourage you more to look for their work. Finally, just with a brief moment we have left, someone had asked about chart lists, in particular the Mindful Investor Live chart list that I've shown a number of times, and how do they create a chart list like this of your own. So this is a very particular version of the chart list feature that a number of the commentators we've been testing and working with. And at some point we'll look at something like this for a broader consumption. But for now, it's really designed for someone like me to be able to put charts in a way that you can look at. To create your own chart list, all you need to do is go to your dashboard, and there's a chart list button in the upper right. When you bring that up, it'll show you a list. This might be very empty. Click on New, and it'll walk you through very quickly a little wizard to create a chart list name, and then from anywhere you can start to add charts to your running list. So thanks so much, everyone, for writing into the mailbag. Again, really appreciate all of your questions. If we don't get to them on the air, I'll try and get back to you over email just to help you understand what we're looking at. And again, please keep the questions and the feedback coming. We read everything and we appreciate it. I want to wrap up today's show with the 3 and 3. As you know, if you've watched the show before, we like to look at 3 charts in 3 minutes at the end of every show. And again, if these charts are not on your radar, if these are not things that you follow, these are the types of things that I would encourage you to put on your radar very quickly, because there are charts I think that are going to be very important for the next couple weeks. The first chart here is the S&P 500, the Spiders ETF, and I'm showing it using on-balance volume at the bottom. Now, if you're not familiar, someone had asked about volume by email, and I talked about just how to think about volume in a previous show. And on-balance volume, out of all the volume analytics that I use, on-balance volume is probably the most common. And what that does is it strings together the daily volume and shows you the trend in volume over multiple days, multiple weeks, multiple cycles. And so what's interesting here on the chart of the S&P 500, we can see over the last 6 months, this upward trend in the spiders. We can see this overall, stagnation and then rolling over. So as the S&P has gone to higher highs, higher lows, the on-balance volume, lower highs and lower lows, that suggests a broader drying up of volume, less volume supporting the up days than the down days. So more in the bearish camp than the bullish camp at this point. Chart number 2 is looking at cap tiers in the US. It's a common chart I like to look at, looking at large versus mid versus small versus micro caps using ETFs. And it's a way overall to just measure the trend and look if there's agreement or disagreement between different parts of the market, the largest to the smallest companies. This is just on a closing basis. So here we can see the S&P 500 in black at the top. The close is here in July, the beginning of September. We're once again back up to that peak, testing a new closing high. We'll see if we get the follow through from earnings. Here in red, we have mid caps to a lower high. Here we have small caps to a higher high, but well below the previous high right now. We're a couple percents below that. And then micro caps have really been the weakest of the bunch, well below the previous high. So again, that's a thing we've looked at over time, with the smallest, most speculative companies lagging behind the largest, most lower beta names at the top of the market cap list. Finally, one of my interviews today, we talked a lot about the US versus the rest of the world. We'll share that with you down the road. But I think this chart of the URTH, it's the world ETF, essentially an ETF that tracks the entire global equity universe. What I'm looking at here is at the bottom is the relative performance of the rest of the world, the entire world versus the US markets. You can see the underperformance in most of this year, but in the last 6 weeks, look at how that relative performance picture has started to shift. If this relative line would continue higher, I think you're potentially in a situation where a lot of investors are caught off guard with an underweight on international stocks, when having that international exposure could help you outperform the US. That's the final bar for today, Tuesday, October 15th, 2019. Thank you so much for joining us today. As always, you can get to us anytime at thefinalbar@stockcharts.com or on Twitter @finalbarsctv. I want to thank you all for joining us from Minneapolis, Minnesota. This is Dave Keller. Have a great night.